Hey everyone, and welcome back for another deep dive. You know how we do things around here. We take one really interesting piece of market analysis and break it down. So today we're diving into strategic profit taking and high upside stock opportunities for savvy investors. It sounds a little bit intense, I know, but trust me, this one's packed with insights that could really help you level up your portfolio.
You know what's fascinating about this analysis? It's not just about chasing the next hot stock. It's really about a holistic approach to managing your risk and maximizing those gains.
Okay, I am all about holistic approaches. Let's start with something that I think a lot of us can relate to, Walmart and Costco. We're talking two retail giants. They're both doing pretty well. But this analysis paints very, very different pictures of their investment potential.
Yeah, and Walmart's recent stock dip after that warning about the slower profit growth, it's a perfect example of what we call being priced for perfection. So when a company's valuation is already super high, even a tiny bit of bad news can spook investors, and that sends the stock tumbling.
So even with companies that seem really solid, understanding valuation is super crucial. A minor blip for Walmart could be a major earthquake for your portfolio if you're not careful.
Exactly. It's like a house of cards. If that foundation is even a little bit shaky, the smallest breeze can bring the whole thing down.
And this analysis talks about this 50% profit grab on Walmart put options. Now, for anyone out there who's maybe not super familiar with options, can you break that down for us? What does that mean? Why was that such a smart move?
Sure, so think of a put option, kind of like an insurance policy on a stock. It gives you the right to sell that stock at a certain price within a certain time frame. So let's say you buy a put option on a Walmart and the stock goes down. Your option becomes more valuable because you can sell it at that higher predetermined price. And the really smart move here was taking those profits early. Options have something called time decay, which basically means their value erodes over time. It's like an ice cube melting. The longer you hold on to an option, the more that value just drips away. You got to cash in before it completely disappears.
Okay, that is a brilliant analogy. So timing is everything when it comes to options.
To a large extent, yes. You need to be aware of how that time decay affects the value, and you need to be prepared to take profits when the opportunity is there.
All right, so we've got Walmart priced for perfection, vulnerable to even the slightest bad news. Now let's talk about Costco. Their valuation's even higher, right?
That's right, and that's where it gets really, really interesting. Costco's premium valuation means they have very, very little room for error. While their January sales were strong, any slowdown, especially e-commerce or comparable sales, could trigger a pretty significant sell-off.
Okay, so with a company like Costco, how do you balance that potential for growth with those inherent risks? Are you holding, are you buying, or are you steering clear altogether?
I think the key with Costco is caution, and you've got to monitor the data really closely. Keep a close eye on their February sales data that should be coming out pretty soon. Any sign of weakness there could spell trouble.
And what about those Costco puts? Hold tight or trim for profit?
If they've gained 50% or more pre-earnings, trimming those puts for profit makes sense, but holding on to a portion, that can act as a buffer against volatility, especially leading into those earnings.
Got it. Play it smart, protect those gains. Before we jump into the stocks that this analysis is really excited about, there's one more company we need to talk about, Paler. This one took a pretty dramatic hit recently, dropping 20% almost overnight. Ouch.
Paler's situation, where the potential for those Pentagon budget cuts and then some of the insider selling triggered this massive decline, it really underscores the risks with what we call hypergrowth stocks.
But isn't a certain amount of hype and speculation just built into the valuation of any high-growth company? Where do you draw the line between healthy optimism and just completely irrational exuberance?
That is the million-dollar question, and it's something that every investor has to grapple with. Paler's drop, it's a stark reminder that when a company's valuation is driven all by hype, then by solid fundamentals, even the slightest breeze can feel as a hurricane. We have to ask ourselves, is this growth sustainable, or is it built on shaky ground?
So it's not just about Paler, it's about understanding the sentiment in the market and being able to identify those warning signs before the storm hits.
Precisely, Paler is a cautionary tale for all of us. It reminds us to be wary of companies with valuations that seem disconnected from their actual performance. We need to look beyond the headlines and really dig into the fundamentals before we make any investment decisions.
Okay, I'm starting to get the picture sound analysis. A healthy dose of skepticism. That's the recipe for success,
You
right?
got it. Now, are you ready to shift gears a little bit and talk about the companies this analysis thinks could deliver explosive growth?
I'm always ready for explosive growth. Bring it on.
All right, let's dive into the exciting world of high potential stocks. First up, Celsius Holdings.
Ah, Celsius. The energy drink company, I've seen their stock popping up on my radar lately. What's the story there?
They're making waves, literally. They recently acquired Alani Nu, another energy drink brand, at a pretty significant discount. It was a strategic win, snagging a fast-growing brand like Alani Nu. They're boasting an estimated $600 million in revenue at a 40% discount.
That sounds like a pretty saggy move. But what about their financials? This analysis mentions revenue recovery and margin expansion. Is that enough to justify all the hype?
It's true that their income statement might look a little shaky right now, but the expectation is that this is kind of a trough quarter for them. Things are going to start looking up. Their focus on those fitness-focused energy drinks positions them well in a growing market segment.
So they're betting on that health-conscious consumer. Interesting. All right, next up we have Cheesecake Factory. I have to admit I'm a little bit biased because I love their cheesecake, but I hear there's more to this story than just delicious dessert.
There is, and it might surprise you, there's a hidden gem within Cheesecake Factory called Flower Child Think Healthy Fast Casual Dining. The analysis actually compares its growth potential to the early days of Chipotle.
Whoa, hold on, Flower Child. The next Chipotle. That's a pretty bold claim.
It is, but Flower Child's rapid growth and their strong customer loyalty, they definitely warrant attention. They're looking at expanding by 25 locations a year, which could be a serious game changer.
And there's even talk of a dividend cut to fuel faster expansion, right? But isn't a dividend cut kind of a risky move? What if Flower Child doesn't live up to the hype?
It is certainly a gamble, but it could pay off big time if Flower Child delivers on that potential. It signals a commitment to prioritizing long-term growth over those short-term shareholder payouts. Investors are going to be watching very closely to see if this bold move actually pays off.
Okay, I'm intrigued. So we've got energy drinks, we've got healthy, fast casual dining. What else is on the menu for explosive growth?
Let's move on to a company I'm sure you're familiar with, Meta.
Meta, the social media behemoth. Aren't they facing all sorts of challenges with privacy concerns and competition from all these newer platforms?
They are, but here's the thing. They're trading at a lower PE ratio than Walmart, which is pretty surprising considering their reach and then influence. This analysis highlights Meta as an undervalued titan.
That price target for Meta is definitely eye-catching, over $1,500 in the next 12 to 24 months. But what are the realistic chances of it hitting that level? What are the potential roadblocks?
The key is going to be the monetization of their AI capabilities. As they get better at leveraging AI for advertising, their revenue and their profitability could really skyrocket. But you're right, there are definitely challenges. The metaverse, it's still unproven territory, and the competition is fierce.
All right, so Meta potential giant, but lots of hurdles to overcome. Who else is on our list of high potential stocks?
Last but not least, we have AMD, the chip maker. This is a play on the exploding AI chip market.
AMD, I've heard good things. They're giving NVIDIA a run for their money, right?
Exactly. AMD is really well positioned to capitalize on the massive growth in AI, especially with their strong offerings in data center and edge computing. And get this, the author of this analysis is personally investing in AMD, which speaks volumes about their confidence in the company's future.
Wow, that's a pretty strong endorsement. Okay, so we've got Celsius riding the energy drink wave, Cheesecake Factory with that hidden gem Meta poised to dominate AI advertising, and AMD at the forefront of the AI chip revolution. It's a lot to process. Where do we even begin?
We'll unpack it all, don't worry, but before we get into the nitty-gritty of these individual stocks, let's take a step back and talk about the underlying principles that guide successful portfolio management.
Okay, I'm ready to get philosophical. That's the big picture wisdom here.
The analysis emphasizes two key rules: being greedy with longs and cautious with hedges, and spend less, invest more.
Greedy with longs. Now that sounds intriguing. I'm all about maximizing gains. Tell me more.
It essentially means letting your winners run. Don't be afraid to hold on to stocks that are performing well, even as they climb higher.
But how do you know when to hold them and when to fold them? Isn't there a risk of getting too attached to a winning stock and riding it all the way down if things turn sour?
You're absolutely right. It's a very delicate balance, and that's where the cautious with hedges principle comes in.
Right back to the Walmart example, taking profits on those put options early. That was a textbook example of being cautious, wasn't it?
Exactly. You're protecting your downside while still allowing for those potential gains on the upside.
So it's about having a plan and sticking to it, even when emotions are running high. What about that spend less, invest more rule? That one really resonates with me, especially in today's economy.
It's a simple but powerful concept. It's about prioritizing investing over mindless spending. The idea is to consistently allocate those funds toward building positions in your high-conviction stocks, ideally on a monthly basis.
So every dip in the market is a buying opportunity. I like the sound of that. But seriously, how do you stay disciplined and avoid the temptation to chase the latest trends or panic sell when things get rough?
That's where the real work of investing comes in educating yourself, understanding your risk tolerance, and developing a long-term strategy that you can stick with through thick and thin.
Well said. This deep dive is already proving to be incredibly insightful. We've covered so much ground, from understanding valuations and hedging strategies to exploring the growth potential of these four exciting stocks. But I have a feeling this is just the tip of the iceberg.
You're right, there's much more to explore, but before we move on, I want to leave our listeners with a question to ponder. Of these four companies, Celsius, Cheesecake Factory, Meta, and AMD, which one intrigues you the most and why?
That's a great question. We'll be back to share our own thoughts and continue this fascinating exploration. Until then, happy investing. Welcome back to the deep dive. So I'm curious to hear what our listeners thought about that question we left them with. If they could only invest in one of those four companies, Celsius, Cheesecake Factory, Meta, or AMD, which would it be and why?
That is a tough choice. They each have their own unique appeal, and I bet some people are really drawn to the tech plays like Mega and AMD.
Yeah, I know I am. But before we reveal our own picks, let's go back to that broader investment philosophy that the analysis emphasizes. Being greedy with longs, cautious with hedges, and spend less, invest more. I feel like we can really unpack those ideas in a practical way by looking closer at these four companies.
You're right, these aren't just catchy phrases, they're guiding principles that can help you make smarter decisions no matter which stocks you choose.
Okay, so let's take that first principle, being greedy with longs. We talked about this a little bit with Meta and AMD. But how does that apply to a company like Celsius, which is still relatively early in its growth trajectory?
That's a good question. Being greedy with longs doesn't mean you just blindly hold on to any stock that goes up. It's about having conviction in a company's long-term potential and being willing to kind of ride out those ups and downs that the market throws at you.
So with a company like Celsius, you'd be looking for signs that their strategy is working, that they're gaining market share, that their financials are moving in the right direction.
Exactly. You want to see that they're executing on their plan, that they're not just a flash in the pan, but a company with some real staying power.
And that's where the cautious with hedges part comes in, right? So how would you apply that principle to a company like Celsius?
Well, you wouldn't necessarily need to go all in on day one. You could start with a smaller position and then gradually increase it as you gain more confidence. And you could also think about using options strategically to limit your downside risk.
So, for example, you could buy put options on Celsius to protect yourself in case the stock takes a hit, so you're not completely exposed if things go south.
Exactly. It's like having an insurance policy on your investment. You hope you never have to use it, but it's there to give you that peace of mind.
Now let's shift gears a bit and talk about Cheesecake Factory. I'm still a bit surprised by their inclusion in this analysis, but the more I think about it, the more intrigued I become. This hidden gem Flower Child seems to be the key to their whole growth story.
Flower Child represents a really interesting opportunity for Cheesecake Factory. They're tapping into this growing market segment, people who want healthier, more sustainable food options, but don't want to sacrifice convenience or flavor.
And the analysis suggests that Flower Child has the potential to grow at a similar pace to Chipotle in its early days. That's a pretty ambiguous comparison.
It is, but Flower Child has a lot going for it. They've already established a strong brand identity, they have a loyal customer base, and they're expanding strategically into new markets.
But what about that potential dividend cut? Doesn't that signal that they're maybe struggling financially? I mean, why would a company cut its dividend unless it was facing some headwinds?
Yeah, it's true that dividend cuts are often seen as a negative sign, but I think in this case it's a sign that Cheesecake Factory is serious about investing in Flower Child's growth. They're willing to sacrifice those short-term shareholder payouts to fuel that long-term expansion.
So it's a gamble, but a calculated one. They're betting that Flower Child will become this cash cow that will more than make up for that lost dividend income.
Exactly. It's a bold move, but it could pay off big time if Flower Child lives up to its potential.
Now let's talk about Meta. I think almost everyone's familiar with their social media platforms. But this analysis highlights their potential in AI-driven advertising. What's the story there?
Well, Meta is sitting on this gold mine of data, billions of users interacting on their platforms every day. And they're getting much smarter about how they use that data to target ads and to personalize user experiences.
So it's about leveraging that vast user base to create a more effective and profitable advertising platform.
Exactly. And AI is really the key to unlocking that potential.
But aren't there some privacy concerns around how they're using all of the data?
Absolutely. That's a valid concern. And it's something Meta needs to address if they want to maintain that user trust and continue to grow their ad business.
Okay, so there's potential, but also risk. And then there's that whole metaverse thing, which seems like a bit of a wild card at this point.
The metaverse is still very early stage, and it's anyone's guess how it's going to evolve, but Meta's betting big on it, and they definitely have the resources and the talent to be a major player.
It is fascinating to think about how the metaverse could change the way we interact with each other and with brands. It's like a whole new frontier.
It is, and it's definitely a space that investors should be paying attention to.
All right, let's wrap up our discussion of these four companies with AMD. They're the chip maker that's riding that AI wave, and the author of the analysis seems very bullish on their prospects.
Rightfully so, AMD is making incredible strides in the AI chip market, particularly in those areas of data center and edge computing. They're giving NVIDIA a real run for their money, and their strategic partnerships with these major tech companies give them a significant advantage.
And the fact that the author of the analysis is putting their own money into AMD, that's a pretty strong endorsement. It shows they really believe in the company's long-term potential.
It does, and when you combine that with their strong fundamentals, their innovative technology, and their growing market share, it's hard not to be excited about AMD's future.
Okay, so we've covered a lot of ground in this part of the deep dive. We talked about being greedy with longs and cautious with hedges, and we explored the growth stories and potential risks of Celsius Cheesecake Factory, Meta, and AMD. I'm ready to hear your pick for that Invest in One Company challenge. Which of these four companies would you bet on, and why?
That is a great question, and I have an answer. But first, why don't you share which company stood out to you?
I'm happy to, but I'm dying to hear yours too. No fair holding back. All right, won't make you wait any longer. Of those four companies, the one that really stood out to me was AMD.
Interesting. Tell me a little bit more about what's making you so bullish on AMD.
Well, for one thing, the AI chip market, it's just exploding right now, and AMD is right there in the thick of it, going head-to-head with NVIDIA. And plus the fact that the author of this analysis is personally invested in AMD, that really speaks volumes to me. It's like they're putting their money where their mouth is.
I see your point. It definitely adds a layer of credibility when someone is willing to bet their own capital on a company's success. What else is drawing you to AMD?
Their strategic partnerships, they're working with some of the biggest names in tech. And that gives them a real edge in terms of access to cutting-edge technology and a rapidly growing market.
Yeah, that's true. Those partnerships can be invaluable for a company like AMD. They get access to resources and expertise that would be really difficult and expensive to build in-house.
Okay, so I've made my case for AMD. Now it's your turn. Which company stood out to you? You said it might be a surprise.
Well, you're right. It might not be the most obvious choice, but after weighing all the factors, the company I would invest in is Cheesecake Factory.
Wow. I have to admit, that is not the one I was expecting. I mean, don't get me wrong, I love their cheesecake. But as an investment, I'm really curious to hear your reasoning.
I understand your hesitation, but I think there's a compelling case to be made for Cheesecake Factory, especially when you consider their focus on Flower Child.
Flower Child, their fast casual, health-conscious concept, right? That's the hidden gem that the analysis keeps referring to.
Exactly, and I think Flower Child has the potential to be a major growth driver for Cheesecake Factory. They're tapping into a really powerful trend that increasing demand for healthier, more sustainable food options, and they're doing it in a way that's accessible and appealing to a really wide audience.
But isn't the restaurant industry notoriously competitive? There are so many new, fast casual concepts popping up all the time. How can you be sure that Flower Child will really stand out from the crowd?
That's a valid point. The restaurant industry is definitely not for the faint of heart, but I think Flower Child has a few key advantages. First, they have the backing of a well-established and successful parent company in Cheesecake Factory.
So they have access to resources and expertise that a startup just wouldn't have.
Exactly. They're not starting from scratch. They have a proven track record, a strong brand identity, and a loyal customer base. And they're leveraging those assets to expand Flower Child strategically into new markets.
And then there's that potential dividend cut, which seems like a risky move, but also a sign that they're really committed to Flower Child's growth.
Right. It's a bold move, but it could pay off big time if Flower Child lives up to its potential. It's like they're saying, we believe in this concept so much that we're willing to forego short-term profits to invest in its long-term growth.
So it's a long-term play, but one with a potentially high payoff. Okay, I'm starting to see why you're so intrigued by Cheesecake Factory. You're not just thinking about cheesecake, you're thinking about the bigger picture. Their growth strategy, their commitment to innovation, and their ability to adapt to those changing consumer preferences.
Exactly. And while there are always risks associated with any investment, I think Cheesecake Factory offers a really compelling combination of stability growth potential and a unique brand that really resonates with consumers.
This has been such an insightful conversation. We've explored two very different investment philosophies. Yours focusing on a well-established company with that hidden gem, and mine leaning towards that high-growth, high-risk world of AI chips. It just goes to show that there's no one-size-fits-all approach to investing.
Absolutely. The key is to find investments that align with your own individual goals, your risk tolerance, and your vision of the future. There's no right or wrong answer as long as you're making those informed decisions and staying true to your investment strategy.
And that brings us right back to that wisdom that this analysis shared, being greedy with longs, cautious with hedges, and spend less, invest more. These aren't just empty slogans. They're practical principles that can really help you navigate the complexities of the market and make smarter investment choices.
Well said. And as always, remember that investing is a journey, not a destination. It's about continuous learning, adapting, and refining your approach as the market evolves.
So keep those minds engaged, keep those questions coming, and keep diving deep into the world of knowledge and opportunity. That's it for this deep dive. We'll catch you next time with another fascinating exploration. Until then, happy investing.